Okay, so we've been talking about what's involved in investing or borrowing money, okay, in terms of interest. That's the cost of borrowing money or how much you get paid for investing money. Borrowing is a form of credit, okay? So with the promise to pay it back. Credit is very often used by people, many people responsibly, many people not responsibly, because they figure like when you get a credit card, it's almost like free money. You're not paying any cash. You just have to show them a card. Well, you got to pay it back. Okay. And back about 18 years ago, there was what was called a recession where the economy sort of shrinks. Things get worse. Okay. And the reason for that was many people were not able to pay off their credit. So what they did is they borrowed a lot of money, but they weren't able to pay it back, especially borrowing money for houses. So people lost their houses because they couldn't afford to pay the cost of owning a house. So you've got to be very careful with credit. Here's some reasons why we use it. Okay. So credit is often used for what we call big ticket items. So big ticket items would be things like a house, a vehicle, maybe a really fancy vacation could be a big ticket item, a boat, a cabin, things like that. And we give credit a specific name when we're purchasing a house or a cabin, and that's called a mortgage. And we're going to be talking about mortgages more in the next year. Okay, so that's one big area where credit's used. Another, school. People borrow money to go to school. Okay. Sometimes people use credit because there's unexpected costs that come up. And I gave you an example there, and like as a personal example, a couple of years ago, before I came to work, I went down to my basement and there was water all over my basement because my hot water tank busted open. So that's, you know, an unexpected cost, because that's going to cost me a few $1,000s to replace. Often people don't have that, so they have to borrow it or put it on credit. Okay. You can use credit if you're unemployed, but you got to be really careful with that, because you should only use it responsibly and with the understanding that you're going to be getting employed soon. Because if you just keep building up credit and credit and credit because you can't find a job, that's going to really come back and bite you. And this is sort of a special case, this last one, is sometimes people actually borrow money to invest money because it may cost them not very much to borrow it in interest, but then they invest it in something that pays a lot of interest, right? So they get a bunch of money back, they pay off their credit, and they end up with some extra money. But boy, you've got to really know what you're doing if you're going to be doing something like that. So those are different ways in which credit is used. Okay, you always have to be approved for credit. Okay, and usually credit comes from a financial institution or some sort of financial institution, oftentimes a bank. Okay, and they look at a number of factors. And those factors are called your credit rating. Okay, so things like, if you borrowed before, did you always pay off on time? Have you paid your credit cards on time? Okay, what's your financial status? How much are you making a year? Any current debt you have, like maybe you have a mortgage on a house, maybe you have an amount owing because you purchased a vehicle. Okay. And they also look at something called your net worth. Your net worth is basically things of value that you have, like a house, a vehicle, investments, minus things you owe. So it could be you own a house, but you owe a mortgage on that house, things like that, right? And oftentimes you can offer your assets as security because, I mean, maybe you don't have the greatest credit history. You know, maybe you're not making a lot of money right now in your job and you have a fair amount of money that you owe. So they would look at something like, okay, well, if you can't pay off your stuff, you have to put your house up as collateral. Say that, you know, okay, if I can't pay this stuff off, you can take my house. And again, that's pretty extreme situations. Okay? And again, that 2007 recession that I talked about, that's what happened. People could not, they could not afford to pay their mortgages. So the financial institutions took their houses. And that caused a bad economy. Types of credit, and we're going to go into these in more detail in the next few lessons. Okay? First one that probably jumps to mind to you is a credit card. You know, credit cards, they can be good if they're used responsibly. If you pay off however amount you spend on your credit card every month, you know, it can be a good thing to use because it helps, you know, you don't have to worry about paying cash up front, especially if you're going to be getting cash later that month. It helps build your credit rating if you pay it off regularly. And I'll talk about credit rating in a second. Okay? But if you don't use it responsibly, it can really hurt you. Okay? Because, and the big thing to remember is when you have a credit card, it's not free money. You've got to pay it back at some point. You can also go to your bank and get a personal line of credit. So they will say, okay, you know, given your financial history and your credit history, we're going to give you a personal line of credit of $100,000. That means you can borrow up to $100,000. You don't have to borrow the complete $100,000 anytime you want, and then pay it off within a certain time. So a lot of people use that, like if they're doing home renovations or something like that. They'll go into a personal line of credit, maybe borrow $50,000, and then pay that off regularly until it's all paid off. Okay? And so it's things like, you know, like home renovations, you may not have $50,000 in cash. So that's why a personal line of credit works well. Personal and consumer loans. Okay. So a consumer loan, amount of money that's lent to an individual for personal, family, or household purposes. You could maybe take a loan for school, for example. You could take a loan to purchase a vehicle. There's other different reasons why you can take loans. It's basically you're taking a loan because you don't have the cash right now and you want something. Okay. And usually these consumer loans, the personal loans, they're paid off in 5 to 7 years. Okay. So you would probably borrow more from a personal line of credit than you would from a consumer loan. Okay. In general. And finally, and you may not even realize this, because I'm sure you have bank accounts, you have something called overdraft protection. That means if you've got, say, a checking account and you've got money in it, and you purchase something, but your checking account goes below zero, it can go below zero to a certain amount as long as you pay it back. Okay? So like if you, so it's not like you would be declined, if you tried to purchase something and your account went below zero, but it would now become overdraft. Okay, so you're protected against basically your card, credit card, or debit card being rejected. Okay, to say that, yeah, we'll put it through, but you're now in overdraft. And finally, this is very common now, credit reports. A lot of different organizations do credit reports. And a credit report is basically, like it says here, a summary of your credit history. Okay? So it's things like, how many credit cards do you own? Do you have a mortgage? Are you paying off a vehicle? How do you pay your monthly payments for whatever expenses you have each month regularly? Okay? And the more you do that, the higher your credit score is going to be. And usually a credit score ranges from 300 to 900, where 300, it could be tough to borrow, whereas 900, you're in excellent financial shape, and banks and financial institutions would be happy to lend you money. So just as an example, just to finish this off, so here's an example of a credit rating company called Credit Karma, which I'm part of. So if I log in, it's going to show me my credit score. And right now, out of 900, my credit score is 900. So that's the highest I can get. So that means I'm in good shape. And you see the bar is all filled. So if you're down, if only this part was filled, you'd be like down around 300, but if the whole thing's filled. And then it gives you a list of things. Like, for example, it explains some things to you. Latest changes, no changes to my latest report. And then it gives you some information on your credit history. So my payment history is 100%, which means that I pay all my bills by the due dates. And thank you. So, and it tells you how much credit you have. So I have like $170,000 available that I could borrow if I wanted to, but I'm only borrowing 1% of that. So I'm not borrowing very much, which again is a good thing. Derogatory marks, if there were public records or collections that were imposed on you, that's going to hurt you. Okay. And what else we got here? Also tells you if people have inquired on your report, so that could be banks or financial institutions. If you decided to borrow money, they want to check out your credit rating. Okay. Tells me my oldest credit cards. Tells me that I have 7 open accounts for credit and 16 closed accounts. So it gives you good detail. Okay. You want to build this up as soon as you can. Okay. Because at some point, you're probably going to have to be spending a lot of money for something, whether it be a house, whether it be a vehicle. So you want, and you won't have the cash to pay for it. So you want to make sure you have a good credit rating so that banks and other financial institutions will not only say, yes, we'll give you a loan, but they might even give you a lower interest rate. And they might even let you take longer to pay it off. Okay. Whereas if you're high risk, you may not get a low interest rate. You may get a higher one. Okay. So like I said, we're going to go more into detail on the credit in the next few lessons. But that's essentially all I wanted to say today.